Business Finance Unit 1, Sources of Business Finance 1.1 Responsibilities of the Finance Department 1.2 Why Businesses Need Finance 1.3 Working Capital 1.4 Capital Expenditure versus Revenue Expenditure 1.5 Internal Finance versus External Finance 1.6 Short-Term versus Long-Term Finance 1.7 Choosing the Right Source of Finance. Responsibilities of the Finance Department. A. Keeping records of payments and revenues. B. Preparing financial accounts. C. Preparing cash flow forecast. D. Providing financial information to top management. E. Choosing the right source of finance capital. Why businesses need finance? For startup, businesses need money to purchase equipment and raw materials so as to begin trading. It is also known as startup capital. 2. For expansion, the business wants to increase its market share. It will buy new fixed assets. It will invest in research and development so as to come up with new products. 3. To increase its working capital. Working capital is the money needed in a business to pay its day-to-day expenses. These expenses are purchase of raw materials, paying wages, electricity and water. Working capital means capital needed for the day-to-day running of the business. Working capital. Working capital is the finance money needed by a business to pay its day-to-day costs. In accounting terms, working capital equals current assets minus current liabilities. Capital expenditure vs. revenue expenditure. Capital expenditure is the money used to purchase non-current assets that last for more than 1 year. For example, purchase of machinery, vehicles, buildings. Revenue expenditure is the money used to pay for day-to-day expenses in the business. For example, payment of utility bills, wages, salaries. Internal finance versus external finance. Internal finance is the money obtained inside the business itself, whereas external finance is the money borrowed from outside the business. Internal finance belongs to the business, whereas external finance does not belong to the business and should be repaid. Internal finance. External finance. Retained profit sale of existing asset and inventory owner's savings. Bank loans or overdraft issue of shares or debentures, debt factoring, government grants or subsidies, crowdfunding. Short-term finance versus long-term finance. Short-term source of finance is money borrowed and that must be repaid within 1 year, whereas long-term source of finance is money borrowed and that can be repaid over several years. Short-term finance. Long-term finance. Bank overdraft, trade credit, debt factoring. Bank loan, hire purchase, issue of shares, issue of debentures, leasing. Choosing the right source of finance. Before deciding where to obtain finance, the business will consider the following. 1. Purpose and time. The business must know if it needs the money immediately or if it needs the money at a later date. The business must also know the reason why the money is needed. If it needs the money to purchase inventory, then the business will use short-term finance, whereas if the business needs money to purchase a fixed asset, then it will use long-term finance. 2. Amount required. The business must know the sum of capital needed so as to determine the type of finance it needs. If the business needs a small amount, it can use short-term or internal finance, whereas if the business needs a large sum, then internal finance may not be sufficient and external finance will be required. Three. Risk and gearing. The business must consider the amount of previous finance borrowed so as to decide what finance it will use. For example, the business may not use bank loan if it already has taken one, or the business may not use leasing if it has already taken one. Also, a business such as a limited company will prefer to issue shares and debentures in order to reduce its gearing. Retained profits. Retained profit is money kept in the business for future investment after shareholders have taken their share of dividend. Retained profit does not have to be repaid back. Retained profit is easily accessible because it is available inside the business. Shareholders may be discouraged to invest in the business. New businesses will not have retained profit. Sale of existing asset. Business can sell their existing unused old asset for cash. The business makes good use of its idle, tied-up cash. It does not increase the debt of the business. Selling existing asset may take time, and so it is not immediate capital. The business may not recover the full amount of capital invested in the asset, and so the money received may not be sufficient. Sale of inventory. A business can sell its unused stocks for cash. The business reduces storage costs and warehouse space. The business makes use of tied-up capital, and so it avoids risks of obsolete inventory. The business may not have enough buffer stock to meet unexpected demands of consumers. The business will not meet customers' orders on time if inventory of raw materials is delayed from the supplier. Owner's saving. The owner can use his or her personal money to invest into his or her business. The owner does not have to repay anyone, and it is easily available. The owner retains full control of the business. The owner may not have sufficient savings to invest. The owner is increasing its risks because it may not have enough working capital to run the business. Bank loan. Bank loan is money borrowed from a bank and repaid with interest for an agreed period of time. It is quick to arrange for a bank loan, and the length of repayment can be negotiated with the bank. Large sums of money can be obtained from the bank so that the business can finance investment project. Bank loans may have high interest rates. Bank loans are secured against an asset owned by the business or a collateral. Issue of shares. Issue of shares mean that limited companies sell shares to investors in exchange of capital investment, and in return the limited company gives the investor ownership and dividend. It is important to note that private limited companies can sell shares only to family and close friends, whereas public limited companies sell shares to the general public on the stock market. The business can raise large sums of money from investors that is used for business expansion. The business does not need to repay back money from investors, and so the gearing of the business is low from share issue. The business must pay shareholders dividend as a return for their investment until the business is in existence. The original owners may lose control and ownership of the business to the new majority shareholder. Issue of debentures. Issue of debentures mean that limited companies raise capital from investors in exchange of a fixed interest rate every year along with repayment of the principal debenture amount over an agreed period of time. The business retains control and ownership because debenture holders are not involved in the running of the business. The business can raise large sums of money from investors. The business must repay back debenture principal amount with interest to debenture holders. Debentures increases the gearing of the business because debenture is a long-term debt. Debt factoring. Debt factoring is an agreement where a business sells its credit sales and trade receivables to a debt factor company at a discounted price in exchange of immediate cash. The business receives immediate cash from the debt factoring company, and so it improves the cash flow of the business. The business avoids the risk of chasing credit customers to pay their debts and also avoids the risk of having bad debts. The business does not receive full cash refund of the value of its credit sales, and so it reduces profits. The business may damage its relations with its customers when selling off its debts to a debt factor company because customers may not like or trust the debt factor company, which will get access to their personal details. Microfinance. Microfinance means providing financial services such as small loans to businesses which have not received money from banks. The business does not require any security or collateral to obtain microfinance. The business can easily and quickly get access to microfinance because no complex procedures or documents are required. Microfinance allows the business only a little sum of loan that may be insufficient for the business. Microfinance can have high interest rates and harsh repayment conditions. Crowdfunding. Crowdfunding is a source of capital that comes from a large number of individuals who invest small amounts of money to finance a new business venture through the use of social media and crowdfunding websites. Crowdfunding gives access to funds that traditional banks would refuse. Along with access to finance, crowdfunding gives marketing exposure to the new business so that they can attract new customers. Bank overdraft. Bank overdraft is a short-term credit extension offered to a business when its bank account reaches zero balance. The overdraft allows the business to withdraw money even when its account has no funds in it. Bank overdraft is a flexible form of borrowing that allows the business to continue its operations such as paying its day-to-day expenses. Bank overdraft is quick to arrange and so the business can fund emergency cash shortages. Bank overdraft have high interest rates. The bank may ask for repayment of the overdraft at any time. Trade credit. Trade credit is a source of finance where a business is allowed to purchase materials and pay the supplier at a later date, and so the business is in a better cash flow position in the short term. Trade credit is an easy access to finance to the business because it has no extra cost compared to other finances. Trade credit improves the short-term cash flow position of the business because the business can use the money to fund other expenses. The business may have to pay penalty charges if payment is made after the agreed time period. The business does not get discounts for its purchases, and business-supplier relationship can be damaged if payment deadline is not respected. Hire purchase. Hire purchase is the buying of an asset with an initial down payment and pay the remaining balance on installments with interest. Ownership of the asset is transferred to the buyer upon full payment of the value of the asset. Hire purchase allows the business access to expensive assets and machinery needs for expansion because the business does not need to find large sums of cash to purchase the machinery. Hire purchase allows the business to spread the cost of the equipment purchase over time, and the business has the flexibility to pay off the remaining amount in full settlement. Hire purchase have high interest payment and the business ends up paying more for the asset. If the business fails to pay the monthly installments, the seller has the right to seize the asset. Leasing. Leasing is an agreement where a business is given permission to use an asset without actually owning it. Lease is given in exchange of a monthly lease charge. The business can use an asset to expand its operations without having to find capital to purchase the asset. It improves the cash flow position of the business. The cost of leasing the asset is higher than actually purchasing the asset. Leasing charges are costly and it is not a long-term solution because the business will not own the asset. The asset can be taken back from the business in case the leasing company is closed down and so disrupting the operations of the business.